Hi, I'm Erik Ogard, CIO of the WealthPlan Group. Today's July 1st. It's Independence Day week. On the 4th, we'll celebrate our nation's independence. That's a momentous day. In fact, in the course of our history, it's the biggest day as Americans. So wherever you may be, I wish you a very happy 4th of July. Hope you enjoy the time with your friends and family and celebrating our nation's history. Turning our attention to markets, we happen to be right at the mid-year point. And so we've got some interesting things to observe about the economy and the markets, which might be enlightening. So with no further ado, let's get into it. A couple weeks back, we wrote a research note called A Different Kind of Bull Market, kind of assessing what's driving the US stock market to new highs. And if you read that piece, I'd encourage you to do so. It's pretty illuminating with respect to the long-term return patterns in place right now. So if you look at the year-to-date return on the S&P 500 index, you'll see that it's slightly over 15%. So you might think, all's well, we're in a bull market. Shoot, if we can do that again, we'll be over 30 for the year. As Lee Corso on Game Day says, not so fast, my friend. So maybe we do, but probably we won't. It seems like we're going to get into some tougher sledding, if for no other reason that we've got incredibly high valuations in stocks. But let's kind of peel back the layers and ask ourselves, what's inside of the S&P that's driving it so high? And in that same note, a few weeks back, entitled A Different Kind of Bull Market, we looked at the top drivers of that index, and it's purely large cap tech driving the index higher. In fact, it's so dominated by the largest 10 holdings in the index that if you look at an equal weighted return year to date versus that 15 plus return for the S&P, it's coming in at a very tepid 4.5%. So that's quite interesting. The other thing to note is if you go back to the sell-off in April, on April 19th, the S&P was only up 4.5% year to date. So in the last, say, 8 weeks, that index has gone on a 11% performance tear. And if you look at those equally weighted names, they've not joined, or the equally weighted index, that index has not participated. So we see the S&P, the cap-weighted S&P at an all-time high, and we see a meaningful lag from the equally weighted index. Keep in mind, it's the same 500 stocks. The only difference is the weighting. And so that large cap tech dominated return of the S&P, really we got to keep an eye on it, especially because valuations are incredibly stretched. Now, looking at that equally weighted, it's not even back at its all-time highs. So we've had a very narrow advance from mid-April until the end of June, which is kind of the setup for the rest of the year. And now we've got very expensive big cap tech names dominating that index. But let's kind of peel the layers back even further and ask ourselves, okay, what's the year-to-date experience for the NASDAQ, the Russell 2000, the Russell Microcap Index? So what we see is the NASDAQs actually eclipse the S&P. That's for no other reason that it's more tech heavy with bigger weights than the S&P. And then if you look at all of those other indexes, small cap and micro cap, they are dramatically behind on a year to date, like up 1, down, basically flat. So not participating in this market at all. And if you've been watching us for any period of time, we've been asking the question, is this market going to broaden out to include some other names? We think it's going to be exclusively earnings driven. So the question is, do we get the earnings or not? Do we get the follow through to the broader market? Is the AI revolution going to introduce efficiencies that smaller companies can take advantage of and also join the earnings growth bandwagon? We don't know. Another interesting look on this market is to say, okay, what about pure growth stocks or pure value stocks? So we looked at the two S&P indices, the S&P 500 Pure Growth and the S&P 500 Pure Value. So this is only the companies that demonstrate very strong characteristics toward growth or value that we're looking at. And what we see is that S&P 500 pure growth, its return is nearly exactly identical to the S&P 500 return year to date, which means maybe that S&P 500 index is kind of like a growth index. That's certainly what's driving its returns year to date. And then if you look at pure value way down in the 1% area, meaning value has just stumbled and been far behind the broader market returns. So like if we put our academic hats on and we say, what's this experience like to the long-term research on factors that drive stock prices? And we can say with certainty that small caps have underperformed and value has underperformed. And those are two big factors associated with positive return premiums long-term, according to the work of Eugene Fama and Ken French, the so-called Fama-French studies, which is the basis for firms like Dimensional Funds were launched on the research of these academics around these return premiums that persist in markets. So what we find now is there's this huge gulf between small caps and large caps over long periods of time. There's a huge gulf between value and the broader market. And it's so extreme now, the difference between the S&P and the Russell is as wide as it's ever been over long periods of time. So we have either a runaway narrow market to the upside that has to come down, or we have earnings that needs to spread to the broader market so that these other stocks can begin participating. We know this can't go on forever. So it's a really interesting dynamic to think about this. And then finally, what about bonds? Year to date, bonds are basically down as well. So there's been no relief for bond investors with the Fed staying higher for longer. Now, if we go back to the beginning of the year, most market participants were expecting the Fed to cut beginning in March. Now, we at WealthPlan weren't. We wrote a note at the beginning of the year cautioning that it didn't look like an environment where the Fed could raise rates. Inflation was persisting and the economy was strong. So we thought and still think the only reason the Fed cuts is the inflation battle has been won, and then the economy is slowing sufficiently to bring about concerns for recession. Now, we still have the inverted yield curve, which has been a precursor to recession, maybe not a causative agent, but maybe so, but certainly a correlating factor to recession. So we're watching that really carefully. But the implication is, as a bond investor, there's been no help. And if you're more cautiously oriented, meaning that you're valuation sensitive, you don't want to own the indexes or the big cap tech growers because of their valuations, if you've had any kind of defensive posture, that's hurt you. And in fact, the way we manage portfolios at WealthPlan, we run a dividend growth strategy. And that portfolio emphasizes stocks that have a 25-year record of growing dividends, stellar dividend records with income growth for the investor who holds those names being pretty compelling. We have some mid-cap names there, and sadly, the dividend growth story has been one that's as neglected as value or small cap from a long-term perspective. Our position on all of this is stick to your knitting. Ask yourself, are you getting from the capital markets a return that is consistent with your risk profile? If it is, then you can be somewhat calm. The returns aren't terrible to the investments that aren't in those S&P and NASDAQ names, but they could be better. And so what we think is now is not the time probably to capitulate, to purchase those things because they're up and everything else is down. We think it's time, much like 1999, where you have to dig into your convictions, dig into what you hold, maybe revisit your risk tolerance. But at the end of the day, if your portfolio is consistent with your risk and meeting your needs, stick with it, because time and again, the long-term adherence to a philosophy and to a risk profile will get you what you need from the market. So don't panic, don't capitulate, and have a great Independence Day celebration. Until next time, thank you very much.